So one of the biggest bulls in the stock market, Tom Lee, actually is feeling a bit bearish himself. Let's take a listen to this.
Tom, welcome. It's good to have you back. I think most people
great to see everybody.
Yeah, I think most people know you as one of the more positive voices about the market from the get-go, really. And I think my first question to you is, how could you possibly still be as positive as you were 2 weeks ago today?
Scott, we can't. We sent a note out to our clients on Sunday evening just noting there are going to be ripple effects from the SIVB failure because the cost of money for banks is going up, so it's going to drive a necessary contraction in credit. And it's pretty clear to us, especially talking to some founders, that not only are many nervous where they bank, but some regulators have actually been advising banks to pull back their sort of lending to fintech startups. So I think you're going to see job losses start. So I think that this is all as Steve put it, a pretty big deflationary impulse coming, and it's almost now raising stakes in terms of what the Fed does. So I think it's tough, Scott, to be bullish here, but it doesn't mean that we've broken the economy.
Well, yet. But
yeah,
I understand. Look, there's a difference between the toughness, your word, of being bullish and just flat out wrong. Is it wrong to be bullish today, Tom?
I think it's wrong to be bullish short term because it's not like anyone can step in today and say, oh, the market's down 2%. I want to buy equities. Now, we haven't been overweight financials. As you know, our top pick this year has been technology, and that's actually holding up great. But the reason I think someone could say you haven't broken the market long term is, number one, the biggest risk to the market has been inflation. I mean, that's been a problem for, number one, banks, because their mortgage holdings and their securities holdings have been hurt by higher rates. And it's also because it's, higher rates and inflation risk have pressured PE. I mean, if we've broken inflation, which is pretty apparent looking at Fed fund futures and the inflation break-evens and even yields, that's actually helping to re-liquefy banks. So it's taking out some of the risk there. But it's also helping PE. The S&P today is at 14 times next year's earnings ex-FANG. So if you look at sort of the median stock, the market has derated huge. I mean, you're getting over a 7% earnings yield today owning equities.
So that was something that I thought was very interesting from Tom, somebody who is notably very bullish all of the time. And so to me, I think that there were some interesting points that he brought up. Tom was essentially saying that the attack from the Fed on inflation is working, in that we're starting to see potential signs of inflation being broken. And what he meant by that was, when he was talking about mortgages and interest rates continuing to climb as far as mortgages are concerned, a lot of that's killing demand, which could kill a lot of PE when it comes to the banks in general. And that creates a ripple effect across the entire economy. So that is bad. What is good is that inflation is coming down. And so now the question becomes, is the Fed going to pause rates, or are they going to pivot and then start cutting rates? And we had this conversation a little bit yesterday about this, and how I felt as if there's a strong possibility that the Fed just pauses. I think it's very unlikely that we see the Fed raise. I think it's even more unlikely that we see a cut. Here's the reason why I think that a cut makes 0 sense for the Fed. Couple things. So we're seeing inflation come down. Make no mistake about that. We saw great PPI numbers based off of expectations this morning. CPI also was in line yesterday. We have a strong jobs market still for the moment. And I've talked about why I think that that's going to also soften up quite a bit. But if the Fed decides to cut this time around, they lose all credibility. Zero. Like the credibility from the Fed right now isn't all that great, considering that they took too much time on raising rates again, repeatedly used the word transitory, even though none of this was transitory. And then they raised rates incredibly fast. And we are now getting to a point where we're starting to see some things break. So if the Fed then pivots yet again and starts to cut rates, that would technically signal a recession. That would signal that the Fed isn't confident that the economy is going to withstand the rates that they raised and that they need to actually start cutting in order to save face. I'm not convinced that the Fed's going to do that, because if they flip again, zero credibility. It's gone. It's out the window. Investors are just going to lose their mind. And I would just be shocked if the Fed comes in and starts to cut rates. So in my opinion, I think that a rate hold is going to be exactly what we see come next week when the Fed meets. And we'll, of course, be reacting to that too. So make sure you're staying tuned, staying close to the channel, hit that subscribe notification bell. But that is where I think is the most likely situation, most probable scenario is that we hold on rates.